Welcome back. Let's talk about individual stocks. Unmesh Sharma from HDFC Securities is now with us on the show. Unmesh, I know you like some of the large banks, or at least in the past, you've had a preference for an ICICI Bank or a State Bank of India. But even if you can't comment on IndusInd Bank, is it a part of your recommendations for large cap banks? What do you does it make itself in the model portfolio, and what have you made of the sequence of events?
Yeah, so it's in the nifty. So naturally, as you know, that we've been cautious since about September last year, and our model portfolio is kind of reflecting that. To a large extent, what ended up happening was that we went quite heavyweight on all the large banks. At this point in time, if you look at our published model portfolio, we are about an equal weight on maybe around the equal weight on IndusInd Bank as well. Now, look, our broader thesis continues to remain the same, which is that in a macro environment which has a lot of risk on the table, both from macro as well as on the individual balance sheets. And, whenever capital markets correct, there are always some, if I may use the term, cockroaches which hide behind these doors. Something tends to happen. Now, in that kind of context, our core thesis that you should remain heavy overweight on large banks, large caps in general, autos, those views hold. Individually on the stock, I can't comment because our research report's not out on that yet.
But have you had conversation with investors? I'm sure you fielded a lot of questions from investors on IndusInd Bank. Everyone wants to know this nifty large bank, which is down 20-25%.
Yeah, no, so it's definitely top of the agenda as of today. But and a lot of people are extremely concerned about. So what we do know is factually is the fact that there is it's about 2.5% of the net worth. If you look at the stock, was not really trading that much premium to the price on a price to book basis. So it's not just concerns about what the impact of this specific thing is. The concern is a lot deeper. A lot of concern about whether what could be the worst case on this. But honestly, beyond that, very difficult at this point in time for me to comment without a published view out there for us.
Unmesh, what's also happened today is that along with IndusInd Bank, other mid-cap private financial banks have also seen significant selling pressure. Are there any risks that such a similar scenario could play out in some of the other banks that have similar such large borrowings? And in that case, do you see further downside, for a lot of the financials?
Okay, so let me break that answer into two parts. One is that why are people reacting like this, which is if you look into history, what ends up happening is that if you believe that there is going to be a risk because of, let's say, a derivatives contract outstanding or the way in which you value something, or if a certain sliver of the entire the lending basket kind of going bad, people tend to extrapolate that. They also tend to believe that if there has been a miss, then it tends to then reflect in other banks which may have had exposure like that. Usually, this goes on for a bit longer than you would think. Till the time all companies which are affected by this come out and give adequate disclosures to the specific event at hand. Is it easy to predict that this is a contagion? Answer is, firstly, I don't think that this is one. The other is that if it is, till the time we get enough disclosures, we won't know. The only thing that I would like to say, which is very different from the last time that we have seen something like this, whether it was back in the day when the ILFS crisis happened, or when any of the small private sector banks, some of which are not under our coverage, have, their balance sheets are blown up and, there was intervention by the RBI. At this point in time, the monitoring mechanism from the last, especially 5 years, from the RBI audits, internal audits, etc., have increased significantly. So expecting that there is a very large hidden contagion out there is going to be a very, very aggressive estimate. So just like in any other scenario like this, what one should do is let the dust settle over a week or two till you've had a chance to converse with each of the managements of the stocks which are impacted, and then take a call as to where you might actually find value. Any large bank which is down on this type of news, I think generally we should start keeping on your radar, because anyway, it's been tough to make money in the market. If there is a dislocation and gives you an opportunity, then why not? I think you should use that opportunity, but not maybe for the next week or two.
let the dust settle down. So Unmesh, tell us about your model portfolio and how it's changed, because prices have changed in the last 1 month, last 2 months, the kind of correction that we've seen. So tell us about your model portfolio.
Yeah, so three things have happened. One is that our model portfolio has not changed as much as you would have thought, because as I was saying, even in September, etc., we were quite cautious. Now, that has been a fairly painful journey, honestly, because what happened was that while our view was that something like this could play out, which is what's happening in the markets now, usually what happens is that if you get purchased too early and markets tend to go up, then we tend to get a little bit of flack for that. But it's played out. If you see, to a large extent, we have hugged the benchmark a lot closer than in the alpha days, let's say, of early 2024, and which is why you will see three themes playing out. One is a natural. While it's a multi-cap portfolio, it's mostly a natural bias towards large cap. You could see that in names like Reliance, in names like the large banks, which we just talked about, and has a bias towards the fact that we believe that urban consumption is something where the green shoots are still not visible, and the rural is the one which is supporting, even though the numbers are not very exciting. So that's the other. Also, what's happened in the quarterly earnings results is that only a third of our stocks, we cover over 250 stocks, have actually beaten estimates, which tends to give us a very big signal that earnings downgrade cycle may have started. In that situation, again, that leads to a large cap bias. So, and with with Mr. Trump coming and becoming the president, what we are noticing is that we are generally trying to stick to domestic kind of names. So equal weight to overweight on autos, large banks, industrials, not very excited by export type pharma names. And that's basically how it is right now. Very, very cautious.
Thank you so much, Unmesh, for joining us, giving us a sense on what's happened as far as the private financial space is concerned, as well as the changes you've made to your model portfolio. Well, as we take your leave on trading hour, the mid-cap index is the only index that at this point of time is managing to hold out on the green. The Nifty Bank, and the small cap index, all of them continue to trade with quads. That is a wrap on this edition of Trading Hour. Stay tuned. Halftime report is up next.